Hello everyone. So guys, this is the second lecture on consolidated financial statements. In the first lecture, we discussed how to calculate the goodwill or gain from bargain purchase, right? This goodwill and gain from bargain purchase we calculate at the date of acquisition. Then we also learned uh, prepare prepare balance sheet at the date of acquisition. Balance sheet at the date of acquisition, right? And I told you at the date of acquisition how you will prepare asset section, liability section, right? And how would you calculate goodwill, gain from bargain purchase, and equity section. So today, what we are discussing today again we are continuing with the same topic, but our topic is how to prepare consolidated financial statement, but at the date of reporting date now. So this is called subsequent to the acquisition date. For example, I'm just assuming, for example, your date of acquisition is 1st January, let's assume 2024, right? This is the date of acquisition, and let's assume this is the start of year also. And then you have a year end, a reporting date. For example, that is 31st December, let's assume 2024. Now, today we are discussing this date. If you will prepare balance sheet at the date of acquisition date, this is called acquisition date balance sheet, right? And if you are preparing financial statement at the reporting date, right? This is called subsequent to the acquisition date, right? And here we will again obviously follow the consolidation process, right? At the end of reporting at this date. So we will follow consolidation process, right? And what is the consolidation process? So please remember here, I'm going to explain first theoretical, these steps you have to remember while preparing the consolidated financial statement. Step number one is all, all line items of assets, liabilities, revenues, expenses, gains, losses, and other comprehensive income of a subsidiary are added item by item to those of the parent. So actually, guys, simply, so when you prepare consolidated financial statements, so you have to take assets of parents plus assets of subsidiary, like it's equals to consolidated assets, right? Similar way, liabilities of parents plus liabilities of subsidiary equals consolidated liability, right? Similar way, revenues of parents plus revenue of subsidiary equals consolidated revenue. And expenses of parents plus expenses of subsidiary equals consolidated expenses. Similar way, you will add gains of parent and subsidiary, losses of parents and subsidiary, and other comprehensive of parent and subsidiary. But make sure, guys, when we are adding these things, okay, so we do not record intercompany transaction. Intercompany transaction, actually, this note is here. So when you are adding all these line by line item, so this point is here, intra-entity balances. Intra-entity balances, this actually, we will spend one full lecture on this kind of things. Intra-entity balances, transactions, income, and expenses must be eliminated in full. So intra-entity balances mean to say, like for example, maybe a subsidiary has to receive some money from the parent, or maybe parent has to receive some money from subsidiary, right? So there could be receivables in one books, payables in the one books, or sometimes there might be a intra-entity transactions, like maybe subsidiary is selling inventory to the parent, or parent is selling inventory to the subsidiary, or maybe subsidiary is selling non-current asset to the parent, or parent is selling some non-current asset to the subsidiary. So these are transactions. So intra-entity transaction, even you have an income or expenses, so it must be eliminated in full. So please make sure when you are adding all these items, assets, liabilities, revenues, expenses of parent and subsidiary, at that time you need to care if there are any intra-entity balances, transaction, income, or expenses. So those things you have to eliminate in full. Why we have to eliminate? Because when we prepare consolidated financial statement, so we assume that subsidiary and parent as a single economic entity, as if they are a single economic entity. So that is why intra-entity transactions, balances, income, expenses, we have to eliminate in full. Okay, this is the consolidation process I'm explaining. Then we have a step, next stage. So guys, let me explain here. So the second point I'm going to explain now, this point. So what is written here? Let's read first, then I'll explain. They're saying no investment in the subsidiary account is presented in the consolidated financial statements, right? So let me give you an example here. For example, here we have a parent company. Here we have a subsidiary company. Obviously, we have a, let's assume, first we will prepare individual financial statements of parent, and we will also prepare individual financial statements of subsidiary. Financial statement means income statement, balance sheet, statement of cash flows, whatever. Okay. So individual financial statements. So please remember, because parent has invested in subsidiary, right? So that is why under parent's balance sheet, under asset section, in parent's balance sheet, under asset section, there will be a one account which is called cost of investment. Cost of investment or investment into subsidiary. So this value will be there, but this value will be reflected in the parent's balance sheet, but in the individual balance sheet only. Okay. So please remember, so this is what is the point now. When we prepare consolidated balance sheet, consolidated, because in consolidated we have to take parents balance sheet and subsidiaries balance sheet, we have to plus these figures. So at that time, this cost of investment which is showing in the parents balance sheet, this we have to guys, simply we have to remove. Okay, we have to eliminate. So this is what is the second point. So saying no investment in subsidiary account is presented in consolidated financial statement. Yes, it is there in the individual financial statement, but it won't be presented in the consolidated financial statement, right? So consolidated statement reports the assets, liabilities of the subsidiary, but other than this cost of investment, right? And because we assume as they are a single economic entity. So your second point is a very simple point. So if you have any cost of investment or investment in subsidiary account, that will not be presented in the consolidated financial statement. So then third point, all the equity accounts of subsidiary are eliminated. All equity accounts. Okay, so let me give you a point to explain here. So again, we have a, for example, parent and subsidiary. Obviously, guys, we have a parent's balance sheet and subsidiary balance sheet. In parent's balance sheet, you will have a parent's equity like common stock, additional paid in capital, retained earnings, for example. Okay, so these kind of things in the parent's balance sheet, and in subsidiary individual balance sheet, they will also have information about their own common stock, their additional paid in capital, their retained earnings. So please remember, when you prepare consolidated equity section for consolidated financial statements, at that time, so we will take common stock of parent only, P only, this. Okay, then we will take additional paid in capital of parents only, again parents only. Okay, that's why they are telling you subsidiaries equity is eliminated. These accounts are eliminated. Only parents common stock, parents additional paid in capital. Then you will plus here retained earning. But this retained earning won't be only parents retained earning. So this retained earning you have to prepare working for that. For that you will prepare consolidated retained earning. So this working we will learn today. Some information we will learn today. Okay. So consolidated retained earnings. So then we will show here one extra figure that would be a non-controlling interest. For that, I will also tell you the small working, how to find out these figures. So this is what they're trying to tell you. So when you prepare consolidated equity, so you have to take common stock of parent plus additional paid in capital of parent plus consolidated retained earnings. For this working we need to learn, non-controlling interest for this working we need to learn, right? So in simple, subsidiaries equity accounts are eliminated. So this is what is written here. They're saying all the equity accounts of subsidiary are eliminated, not presented in the consolidated financial statement. So retained earnings, I already told you, retained earnings of the consolidated entity at acquisition date consists solely retained earning of the parent. Then we will add certain adjustment into parent's retained earnings. So that is why I told you the word here. We will use consolidated retained earnings, and for that I teach you the working. The next point, Then obviously goodwill, goodwill we calculated at the date of acquisition when control was achieved. So goodwill from the acquisition of a subsidiary is presented separately in the non-current asset of consolidated balance sheet. Please remember, goodwill, goodwill will be recorded only in consolidated balance sheet. Goodwill will not be recorded in parent's individual balance sheet. No, no, no. Goodwill will be recorded in consolidated balance sheet, and goodwill we have to calculate. And in the last class, I have told you how to calculate goodwill or gain from bargain purchase, right? Goodwill we always record in consolidated balance sheet, and gain from bargain purchase we record in consolidated income statement. Okay, so this thing we have already learned. Next, intra-entity, I already told you, if you have any intra-entity balances, transaction, income, expenses, so these things we have to eliminate in full. Intra-entity means a transaction between parent and subsidiaries. Okay, so then one more thing, NCI, because I told you when we prepare equity section of consolidated financial statement, that time we need what? We need common stock of parent plus additional paid in capital of parents plus consolidated retained earning plus NCI working. NCI means a non-controlling interest, right? NCI working we have to present. And I told you last time, NCI, what is NCI? I have already defined. So this is what they're saying. NCI is reported separately in one line item in the equity section. Yes, in the equity section, we will show the NCI. So these things are the part of a consolidation process. Now, guys, here we go. Today, I'll explain some adjustments also, and few adjustments, obviously, because this topic is really long topic. Few adjustment we'll discuss in the next class. Here we go. First adjustment I'm going to tell you. This adjustment is relevant to acquisition date fair value. Okay, acquisition date fair value. So what is acquisition date fair value? I told you last time. But let me show you at the date of acquisition. So when we prepare at the date of acquisition, okay, because today our lecture is at the date of reporting. So this we will see, this transaction we will do at this date, but this transaction belongs to the information which we had at the date of acquisition. Transaction we will do at the date of reporting. Sorry, adjustment we will do at the date of reporting. But this adjustment is relevant to the information which we had at the date of acquisition. And in the at the date of acquisition, when we prepare consolidated asset section, especially non-current asset section. So at that time, what we have done, I'm showing you from the previous section, we have already covered. At the date of acquisition, when we prepare non-current asset section. So how we prepared non-current asset section at the date of acquisition? At that time, what we have taken? We have taken non-current assets of parents. This we have taken from the parents' balance sheet. Then we have added their non-current assets of subsidiary. This information we have taken from the subsidiary balance sheet. And then we have added a excess fair value. What is excess fair value? Because guys, whatever assets of subsidiaries are showing in the subsidiaries balance sheet. So those values are called carrying values, right? The values of subsidiaries assets which are showing in subsidiary balance sheet, those are carrying value. Sometime the fair value of certain assets at the date of acquisition might be different than carrying value. For example, let's assume, I'm just assuming, for example, carrying value was 80,000. Let's assume, but the fair value of subsidiary asset is, let's assume, 120,000. Just assuming. So it means 40,000 is the difference of carrying value and fair value. So this is called fair value difference. Sometimes fair value could be greater than carrying value. If fair value is greater than carrying value, then we were adding this information here. We were adding excess fair value like 40,000, for example. And sometimes your fair value could be less than carrying value. Then you have to deduct figure from here. Okay. And then we calculated goodwill there, right? Goodwill will also be there. Now we are discussing here this adjustment, whatever we are discussing now, this adjustment belongs to this point, fair value. Okay. What if fair value is different than carrying value? So this is this adjustment, because this fair value can belongs to depreciable assets and it can belongs to non-depreciable asset. First, I will explain if fair value is different than carrying value, but this fair value difference is belongs to depreciable assets. So how to deal with that? So this adjustment we are discussing, because this excessive fair value we have to depreciate while we are preparing consolidated financial statements. Okay, so this adjustment we are discussing now. So let's understand with the help of example. We have an example here, guys. This is the note, right? Note is what? Adjustment should be made to report the subsidiaries' assets and liabilities at amounts based on their acquisition date fair value. If carrying value is different than fair value, then what you will do? And here I'm assuming what if the fair value is greater than carrying value, and this fair value is belongs to depreciable assets. Okay, so here we go. So let's read with the help of example, and then we will prepare a summary at the end. So they're saying on January 1, year 1. So this I'm assuming it's a date of acquisition. Parent company acquired all means 100% of outstanding shares of common stock of S company, S is subsidiary company. Okay, on the date of acquisition, on this date, the carrying amount of building in Sun's financial statement was 100,000. So carrying value was 100,000. This is carrying value. And its fair value was 120,000. So fair value is 120,000. And we know fair value is greater than carrying value. And this asset is depreciable asset because it's a building. Okay. Sons depreciate this building using straight line depreciation. Sun, he was depreciating this building by using straight line depreciation method over 10 years with no salvage value. So now guys, please remember, first of all, we have to see what Sun should have done in his individual financial statement, right? So this is what Sun's separate financial statements, right? Separate financial statements. At which date? At the reporting date. Reporting date is 31st December, year 1. Okay, not at the date of acquisition, at the date of reporting. Okay, the subsidiary obviously will continue to use this value, whatever was showing in his balance sheet. He will continue to use and depreciate this value only, right? But for consolidation purpose, we should have used what? We should have used fair values. But first, I'm talking about, so in Sun's balance sheet, or in Sun's financial statements, so Sun will report the following amounts of the building based on this value which was showing in his balance sheet at the date of acquisition. So first of all, he will calculate the depreciation expense by using straight line method. For example, value of asset was 100,000, it is given here, divided by life is 10 years, so it is given here. So 100,000 divided by 10 years, so depreciation expense for the year is how much? 10,000. So this depreciation expense obviously he will show in his income statement also, right? Then what should be the building's carrying amount in Sun's separate financial statement? Carrying amount is how? So you will take, this is the value which was showing at the start of year, 100,000 minus the depreciation, okay, which he has depreciated in this year also. So this is the carrying value of 90,000. It means in Sun's individual financial statements, so there is a depreciation expense. There is a depreciation expense of 10,000 and the carrying value of building is 90,000 in Sun's financial statement. Now, please remember, now we are discussing what we have to do in consolidated financial statements. Okay, at the end of year, consolidated balance financial statement. In consolidated financial statement, we have to use the fair values of assets, fair value of asset, fair values. Okay, if, because consolidation is based on acquisition date fair values, right or wrong? So now we have to use fair value. What if we will depreciate? We will depreciate this fair value. And if we will calculate the carrying value of asset based on this fair value, so what will be the information? So here we go. So for example, first we will calculate on December 31st, year 1 for the consolidated financial statement. First, we will calculate what? Depreciation expense. Depreciation expense, how? It should be based on fair value, and fair value was 120,000. And life of asset is 10 years. So depreciation expense should be 12,000. Right? Then buildings carrying amount. What should be buildings carrying amount? Based on fair value. So fair value was 120,000 minus depreciation of this year. So carrying value is 108,000. Now look at here. Try to understand now. Guys, when we, please, now see, because when we prepare consolidated financial statement, for example, if you are preparing consolidated income statement, so we will take parents depreciation expense plus subsidiaries depreciation expense equals consolidated depreciation expense, right? Normally. So parents depreciation expense is not given. Subsidiary depreciation expense is there. For example, I can assume this value, any value, plus subsidiary depreciation expense is 10,000. So this is consolidated depreciation expense, right? But this figures we have already added 10,000. But now technically you have to think. Technically, you have to think this depreciation should have been based on the fair value. This depreciation of subsidiary should have been added in the consolidated balance financial statement based on fair value. But this 10,000 is already added based on the carrying amounts, based on the old values, but it should have been added based on the fair values. Now it means how much depreciation we should add further to reflect the fair value. So look at here, we will simply take the depreciation difference. Old depreciation was 10,000. Depreciation based on fair value is 12,000. So 10,000 is already added. Further 2,000 depreciation if I will add. Further 2,000 depreciation if I will add. So this will be now consolidated depreciation. So simply what we will do, guys, now, while we will prepare, listen me carefully now, while we will prepare consolidated financial statements. So we have to compare old depreciation and new depreciation, and there would be a result either increase in depreciation or decrease in depreciation. If increase in depreciation is there, obviously increase in depreciation will be there if fair value is greater than carrying value. So there will be increase in depreciation. So increase in depreciation is how much? 2,000. This 2,000 we will add, okay, in consolidated depreciation expense, because 10,000 is already added. Okay, further 2,000, which is the difference of fair value, difference or depreciation of the fair value excess, depreciation of the fair value excess. So that will be added in the consolidated. Okay, so then similar way you have to look into the buildings carrying amount. So old carrying amounts in individual financial statements of subsidiary was 90,000, but based on fair value it should have been 108,000. This 90,000 is already added, okay, in consolidated, but so it should have been added 108, right? 90 is already added. So now 108 should have been added. So how much is the difference? Difference is 18,000. So 18,000 is the increase in carrying amount of building. So this should also have been added, should be added in the consolidated financial statement. Now, in simple words, guys, what I have said, so you have to follow this now. Number one, whenever you are calculating consolidation depreciation expense, consolidated depreciation expense, first of all, you have to take depreciation expense from parent income statement, plus then you have to take depreciation expense from subsidiaries income statement. Okay, so these things you have already added, parents and subsidiary. Now plus or minus. If there is a increase in depreciation expense, increase in depreciation expense will be added, and increase in depreciation expense will be in this scenario. Increase will be in this scenario if fair value is greater than carrying value. But if fair value is less than carrying value, then there will be a decrease in depreciation expense, and that should have been deducted. It means this equation you have to remember now. How would you calculate consolidated depreciation expense? For example, you have to take parents depreciation expense, parents. Then you have to add subsidiary depreciation expense. For example, it was 10,000. And then you have to add an increase in depreciation expense, which is 2,000. 2,000, how you got? The difference of 10,000, which is old depreciation, and the new depreciation 12,000, which is based on fair value. So the difference is 2,000. So this 2,000 increase in depreciation you have to add. This will be equal to consolidated depreciation expense, right? Understood. But if there is a decrease in depreciation expense, will be there if fair value is less than carrying value. In that scenario, decrease should be deducted. Okay, should be deducted. Similar way, when you calculate the consolidated carrying amount of the assets, you have to take carrying value of the assets of parent plus carrying value of assets of subsidiary. For example, carrying value of assets of subsidiary was, let's assume 90,000. This value, this is carrying value of asset of subsidiary 90,000. So we have taken parents carrying value plus subsidiaries carrying value 90,000 plus or minus. Plus is what? Increase in carrying value. If carrying value has increased, obviously carrying value will increase if fair value is greater than carrying value. So then this should be added. Or minus decrease in carrying value, and carrying value will decrease if fair value is less than carrying value. So then guys, please remember, if you will take parents carrying value plus carrying value of assets of subsidiary, then plus increase in carrying value, which is in my example, increase in carrying value is how much? 18,000, right? Because in individual financial statement, it was 90,000. And on based on fair value, it should be 108. So increase is 18,000. So this 18,000 you will add it here. Or there could be a decrease in carrying value, then you have to deduct. So this will give you consolidated carrying value, right? So what is the formula for consolidated depreciation expense? Formula for consolidated depreciation expense. Parents depreciation expense plus subsidiary depreciation expense plus increase in depreciation expense if fair value is greater than carrying value, or minus decrease in depreciation expense if fair value is less than carrying value. Increase or decrease you will get by comparing old depreciation with the new depreciation, right? Similar way, if you are calculating consolidated carrying value, so you will take carrying value of assets of parent plus carrying value of assets of subsidiary plus increase in carrying value if fair value is greater than carrying value, or minus decrease in carrying value if fair value is less than carrying value, right? And please remember, this asset was depreciable. So that is why depreciation expense you have to adjust. You also need to adjust carrying value. But if asset is not depreciable, like land won't be depreciated, right? Land won't be depreciated. If land won't be depreciated, because fair value could be different than carrying value, and that asset could be a non-depreciable. In that scenario, consolidated only consolidated carrying value you have to adjust. Don't adjust consolidated depreciation, because there won't be increase or decrease in depreciation expense because asset is non-depreciable. Then only consolidated carrying value you have to adjust, right? Understood? I hope that is clear, right? Now, guys, we are discussing here another thing. First adjustment, we learned how to adjust the difference of fair value and carrying value if asset is depreciable or if asset is not depreciable. Now we are discussing another adjustment for consolidated net income. Okay, so please remember, let me tell you here, whenever you prepare consolidated net income means this net income you will obviously get in the income statement, right or wrong? So please remember here, I'll show you calculation also, don't worry. So please remember the consolidated income statement. When you prepare consolidated income statement, must present separate amounts for following. Number one, you have to show three things separate. You have to show total consolidated net income, which will include the net income of parent plus subsidiary, right? So then we have to take net income attributable to NCI, like this total net income. Okay, total net income we have to calculate. Then out of this total net income, okay, we have to show what is the net income which is relevant to non-controlling interest, and obviously NCI would be under subsidiaries net income, right? Because subsidiary will have non-controlling interest. So we have to simply say how much portion will go to NCI from subsidiary net income, and how much portion will go are net income attributable to the shareholder of parent, like how much net income will go to the parent's shareholder. So these three figures you have to show. I will show you how it will be presented, don't worry. So just theoretically I'm telling you, first you have to show what is total consolidated net income, then net income attributable to NCI, and then net income attributable to parents. So how these figures we can work, so I'll show you with the help of example. Because if I try to produce examples with the theory, it is complicated. So let's do the example directly so you will understand. So here we go, guys. The following are separate statements of income of P. P stands for parent, and S. This is the parent company. This is the subsidiary company. So we have an income statement for both, right? Excluding P's shares of income from S for the year ended 31st December year one. Actually, these are the individual income statements of parent, individual income statement of subsidiary. For example, we are provided information with the sales, cost of goods sold, selling and administration expenses, interest expenses, income tax expense, and net income. So what you will do, guys? So now once, and here I'm assuming here, so I'm assuming pay P is having investment in S, and how much is the voting interest? 80%. I'm assuming. Okay, if 80% P is having voting interest in S, it means 20% is the NCI, non-controlling interest, right? Okay, now it means 20% is controlled by non-controlling people, this S, and 80% share is held by the parent. So now, guys, here we go. And we also assume there is no intra-entity transactions occurred. So now how you will calculate consolidated? Because as I told you, intra-entity transaction, this I'm saying. Intra-entity balances, transaction income expenses, we will eliminate in full. So this, I'll spend one lecture on this, how to deal with intra-entity transaction. And so far in this example, I'm assuming we do not have any intra-entity transactions. Okay, in this example, we don't have intra-entity transactions. So now, guys, so now we will prepare consolidated statement of income. Okay, how you will prepare? So once, if you want to calculate sales, so you will take sales of parent, which is 250,000, plus sale of subsidiary, which is 120,000. Total is 370,000. 370,000. So this is consolidated sales. Then if you have an intra-company sales, so you will do parent sales plus subsidiary sales minus intra-company sales. But I'm assuming we don't have an intra-company, because intra-company sales, intra-company transaction we have to eliminate. But we don't have, I'm assuming here, okay? Similar way, we will deal with the cost of goods sold. We will take parent's cost of goods sold, which is 120,000, plus subsidiary cost of goods sold, which is 70,000. So total is 190,000. And this cost of goods sold we will deduct. But if you have an intra-company cost of goods sold, so you will take parent's cost of goods sold plus subsidiary cost of goods sold minus intra-company cost of goods sold, okay? Or intra-company sale, we will deduct. Then we have a minus. We have to deduct now selling and admin expense. So what you will do, guys? So we will take a selling expense of parent, which is 50,000, plus selling expense of subsidiary, which is 10,000. Total expense is 60. So 60,000 we will deduct here. Then interest expense of parent 20,000. We don't have interest expense for subsidiary. So interest expense we will deduct only 20. Then we have income tax expense of parent 21,000 plus income tax expense of subsidiary 14. So total is 35 we will deduct here. And now this is called net income. So this was the first thing I told you. First, this is called consolidated net income. And I told you whenever you have a net income, so you have to show three figures. Which three figures? First figures you have to show. You have to show total consolidated net income. So this is this figure. Net income, consolidated net income, how much? 65,000. And I told you it includes parents plus subsidiary information. Understood? Now, then second figure, we have to show, net income attributable to NCI. This is how you will calculate. I'm showing you formula here. Net income attributable to NCI. So you will take here NCI percentage multiplied by subsidiaries net income. So NCA percentage into subsidiaries net income. This will give you a net income attributable to NCA, because NCA share is only in subsidiary, not in the parent, right? So we have to take subsidiaries net income into NCA percentage. So here we go. What is the subsidiary net income? Look at from this question. Subsidiary net income is given here, here. 26,000. So we'll take 26,000 into NCA percentage 20%. So if I take 26 into 20%, so this is 5,200. So this is the net income attributable to NCI. This figure will go to NCI later, okay? To NCI calculation. And remaining Remaining, we have to now calculate third figure. Third figure, you have to calculate which figure, guys? We have to calculate net income attributable to the shareholders of parent. And this figure, how you will calculate? You will take parents' net income plus parents' 100% net income you will take. Plus you will take subsidiaries net income multiply by controlling percentage. Because controlling percentage is 80%. So subsidiary net income maybe is 26,000, right? So, but remember this formula, you will take full net income of the parent plus subsidiaries net income into controlling percentage. So this formula will give you net income attributable to shareholders of the parent. So this is how it will be calculated. Now we are calculating net income attributable to P's shareholder. How? So you will take P's net income. P's net income is 39,000, 100% P's net income plus subsidiaries net income into 80%. Subsidiary net income was 26,000 into 80%. If I add these two figures, so this will give you 59,800. And make sure one thing here. Please remember this figure later on will go to NCI calculation. It will be added in the NCI. Okay. And this figure later on will be added to the consolidated retained earning working. This 5,200 figure will be added to NCI working, and this 59,800 will be added to consolidated retained earnings later, because we have to see the working of NCI and consolidated retained earnings. Is that clear? Okay. Now, guys, we are discussing, there is a one more working, the dividend payments, because this working will also adjust later on NCA working, and this dividend payment working will also affect the consolidated retained earnings working. So dividend payments, that's why this working is important. So please remember here how it will work. So let me show you with the help of example directly. So then with example, I'll explain the theory also. So for example, guys, please remember. So let's assume they're saying P and S. P is the parent, B S is the subsidiary, declared and paid 40,000 and 20,000 of dividend respectively. Actually, this 40,000 dividend is paid by P, and this 20,000 dividend is paid by S. Now, please remember here, I want to tell you here. Obviously, parent has given dividend of 40,000 to outsider, all outsiders, to their shareholders. But subsidiary has given dividend of 20,000. Okay, and 20,000, right? If I'm assuming NCA percentage is 20% and controlling percentage is 80%, it means this subsidiary 20,000 dividend, 20% of this 20,000 dividend will be received by NCI, and 80,000 dividend, okay, will be received by parent, right? Because parent is having voting rights. It means 20,000 is the total dividend of subsidiary. Out of that, 20% will be received by NCI, which are outsider, again outsider. But this 80% dividend, which is received by parent, this is intercompany dividend, right? And I told you intercompany dividend, we will eliminate, we don't show in consolidated financial statement. So this is the idea. Only that dividend we will take in consolidated financial statement, which is paid to the outsider, which is paid to the outsider, which is paid to the outsider. Understood? And to outsider, how much is paid logically? So this 40,000 is paid, which is paid by parent 100% to the outsider, and then 20% of this subsidiary dividend is paid to the outsider. So but this is 80%, so this will be eliminated. But working, how you will show? So working, I'm showing you now. Understood? So this is the idea which you have to learn. So here we go. This working, you can just follow this format, because this format can help you to solve many questions. So first of all, you will take dividend paid by parents, which is 40,000. Then we can add here dividend paid by subsidiary in total 20,000. So total dividend is 60,000, right? If I'll add these two figures, 60. But we know the 80% of this 20,000 is intercompany, which is paid to the parents from subsidiary. So this we will deduct now. So we will take parents proportionate share of subsidiaries dividend. So subsidiary dividend was 20,000. and 80% is paid to the parents of this 20,000. So this we will deduct. So this is called now consolidated dividend paid. Consolidated dividend. Okay, but this consolidate, this is the total dividend which is paid to the outsider, total. But guys, we know there is some share which will go to NCI non-controlling interest, because non-controlling interest is there in the subsidiary, right? So we have to calculate NCI share of dividend, NCI share of subsidiaries dividend. How? So you will take subsidiaries dividend, because I show you logic here, right? Subsidies dividend into 20% will go to NCA, right? So this is what we have to do. So we will take subsidiary dividend into 20%. So this dividend, whatever you will get, this is going to be 4,000. This 4,000 again we will deduct. Now remaining 40,000, okay, will be treated as decrease in consolidated retained earning. Now listen, this 4,000 will be deducted from NCI working later on. Okay. I told you in the previous section, I told you this net income attributable to NCI will be added to NCI, and this net income attributable to a parent shareholder will be added to consolidated retained earning. Now I'm telling you what will be deducted from NCI and what will be deducted from retained earning, please. So this NCI share of dividend will be deducted from NCI working, and this decrease in consolidated retained earning will be deducted from consolidated retained earning, and this figure will be equal to the parent's dividend. Dividend paid by parent. Okay, this figures. It means simply dividend paid by parent will be deducted from consolidated retained earning. Understood? So this is what, because next working I'm going to prepare now for retained earning, and then I'll show you the working for NCI also. So here we go. We have our retained earnings. We have a retained earnings here, guys. Now, next working I'm showing you retained earnings. Okay, again, with the help of example, I'll tell you how retained earnings working will be prepared. So, guys, I'm assuming here few figures. Okay, so let me tell you here the format for retained earning, because this consolidated retained earning will go to consolidated balance sheet, right? If you remember, I told you when you prepare consolidated balance sheet, especially consolidated equity section, in equity section you have to take parents common stock, parents additional paid in capital, then consolidated retained earning, which I'm going to tell you now, then NCI, which I will tell you just after a few minutes. Okay, so consolidated retained earning, this working, this figure, how you will get. Number one, here we go. We have an example here. For example, P's equity balance. This is P's parents, because subsidiaries equity balances are eliminated. I told you, right? P's equity balance of 160,000 just prior to acquisition consists of common stock 10,000. They're saying add the date of acquisition. Actually, at the date of acquisition, you have a common stock of 10,000. Then we have an additional paid in capital of 100,000, and then we have a retained earnings of, this is parents I'm talking about. On date of acquisition, parents common stock additional paid in capital retained earning was 50,000. Okay, now this, because this as it will be shown in consolidated, this figure as it will be shown in consolidated, but this figures we have to do the working now to find out consolidated retained earning. And consolidated retained earning, how you will calculate? So this is how you will calculate. First of all, you will take add the date of acquisition. What was the retained earning amount of parent? Retained earning amount was 50,000, as I told you. Okay. So then what we will do? We will plus consolidated net income attributable to parent shareholder, and this figure you will get from consolidated income statement. And this figure we have already calculated, like net income, consolidated net income attributable to parent shareholder. How you got this figure? This figure you have already calculated here. This was the net income, na? This is the net income. Net income attributable to parent shareholder, which includes parents' net income plus from the subsidiary controlling percentage. So this was 59,800. This figure we will add it there. 59,800. Okay. Then we will deduct parents dividend paid since acquisition. This is the parents dividend, and this working you can get from dividend paid working. Dividend paid working, just I told you parents. You know, this figure I told you, dividend paid by parent, this figure which will always be equal to this last figure, which is called decrease in consolidated retained earning, 40,000. Okay, so this 40,000 or this 40,000, you will deduct from consolidated retained earning, right? Parents dividend paid since acquisition, 40,000. So now this is called consolidated retained earning. Okay. Now consolidated retained. Now this will go to consolidated financial statements. And I told you in consolidated financial statement, what will go? In consolidated financial statements, we will take parents common stock plus parents additional paid in capital. For example, parents common stock is 50,000. It's given here. Common stock is 10,000, sir. Given here, na 10,000. Additional paid in capital is 100,000. And now we will add a consolidated retained earnings, which is how much? 69,800. Okay, and now here we have to add NCI value. And for that working, I'm going to tell you. Please remember, this is the basic workings I'm showing you. Okay, without any further adjustment, because we have to study intra-company balances and transactions. So this is basic workings I told you. And I believe it will be more than sufficient even to tackle your exam question, but adjustments I will also explain. Now here we will have a non-controlling interest. Next working I'm showing you, because next figure you have to show for non-controlling interest, right? A parent's common stock we will show. Additional paid in capital of parents, then consolidated earning, retained earning I already told you. Now NCA working. So NCA working, how you will calculate. So this is the formula which we will follow. For example, first of all, you will take NCI, fair value of NCI, fair value of NCI at the date of acquisition. You know, when we acquired the subsidiary and when we achieved the control, at that time, NCI fair value will be given in the question. Okay, so that value we need NCI fair value, acquisition date fair value. For example, I'm assuming it is 30,000. Okay, now we will add here net income attributable to NCI. So this figure, you know, we learned from net income working. So go to the net income working. This is the net income working, right? Consolidated net income. So you have to calculate here net income attributable to net income. Net income attributable to NCI, which includes subsidiaries net income into NCI percentage. 5,200. This will be added in NCI. So first we took NCI at fair value at the date of acquisition, NCI fair value at the date of acquisition. Then we added net income attributable to NCI. Then we will deduct NCI share in subsidiaries dividend. You know, we have taken subsidiary dividend into NCI percentage. This working you can see from the dividend working. Here we have a dividend working. Here we have a dividend working. This is NCI share of subsidiary dividend, 4,000. This figure you will deduct from NCI. 4,000. And now this is called what total NCI at reporting date, right? And now this 31,200 you will show in consolidated equity. You know, in consolidated equity, I told you will show parents common stock 10,000, let's assume. Parents additional paid in capital 100,000. Consolidated retained earning was 69,800. And here you will add NCI value. What was NCI value? Whatever value was there, consolidated NCI, that you will show here. Okay. And it is 31,200, right? So we'll show 31,200. So this is equity, consolidated equity. Understood? And now guys, please remember, we have here some note. We know these notes you have to remember. So this is dividend, this is consolidated treatment. So parents Parents dividend to subsidiary. Usually parents receive dividend from subsidiary, right? Sometimes, look, guys, what we say, usually we say parent has control over subsidiary, right? But sometimes subsidiary might have small investment in parent also, maybe 1%, 2%. Subsidiaries, they can also buy, the stock of parent. Even parent is controlling subsidiary, but subsidiary may have investment in parents also. So if any dividend is paid by parent to the subsidiary, that should be eliminated because it's intra-company. And even if any dividend is paid from subsidiary to the parent, that should also be eliminated because both are intra-company. Then if the parents dividend to third parties, whatever parents is giving dividend to the outsider. In my example, it was 40,000. So this will be deducted from consolidated retained earning working. And what is subsidiary dividend to third party? To third party means a subsidiary dividend to NCI. So that will be deducted from NCI calculation. Understood, guys? I hope so it is clear. Do you have any question, guys? Because after this, what we have? After this, we have adjustments. Okay. Intra-entity adjustments we have after that. Intra-entity elimination. And that is again, I want to spend more time on this because they may ask you some small calculations also. But there are so many adjustments are there. Okay, guys, if you have any question, you can ask me. Otherwise, we will finish this in the next class and I'll try to practice some question also.